So much for that bull market.
Right, exactly. And that just sort of raises the point that was this all a technical? Ed Morse over at Citigroup had a note out right as that rally broke yesterday, saying that about 20 to 25% of crude oil spike price since last week was actually driven by sentiment, not reality. And let's take a look at the two factors that drove oil higher yesterday. One, you had the news that perhaps OPEC was going to be willing to talk about finding a better price, fair prices.
They called it fair price, right?
So perhaps talking to other non-OPEC members, hey guys, let's get together and talk about price. Citigroup pointed out all the big OPEC officials are on vacation. So obviously there couldn't have been real high-level discussions on this. And I raised the question yesterday, who would actually cut when you see Iran is increasing its output, as is Iraq, Saudi Arabia scaling back a little bit, but that's probably due to seasonal demand factors instead. The other factor that really had an impact was the EIA lowered the U.S. production by about 87,000 barrels a day and put June U.S. production down by about 104,000 barrels a day. Okay.
Is that a big number?
Well, that's still 9.4 million barrels a day.
There you go.
Yes, if you read into the tea leaves, it does mean that U.S. production is rolling over faster than expected. But Goldman Sachs raised the question, there needs to be even lower prices. You've got a lot of backlog wells, ongoing productivity gains, higher grading. You're getting more for less in the oil community, so more damage still needs to be done to the oil price in order for these sustained production cuts to be felt.
All right, so let's put this all into context here and bring in some other asset classes as well. I want to bring in Lisa Bromowitz to talk about oil prices' rising correlation with European bond yields. Lisa, you've been covering fixed income for years now. How often have you heard about European bond yields moving with oil?
Well, it comes and goes. And actually, this is something that's a little bit of a challenge right now to both policymakers and bond investors, where you have a pretty direct correlation with the moves in oil prices and the moves in the safe haven bonds, the U.S. Treasuries and the German Bunds. But we don't have a sense, exactly to Alix's point, of exactly all of the technicals that are necessarily behind each particular move. If the IAEA comes out and says something and has a proclamation and it changes it, does that immediately affect bond yields? This could really complicate the matter for investors who are looking to bond yields to get clues on, are we headed toward inflation or are we headed toward deflation? And it's hard for policymakers who are looking at this and saying, should we raise rates? Or is this basically an indication that people are ratcheting back their expectations for inflation? Or is this just purely a technical blip? I mean, Janet Yellen has come out and said, oil prices, the decline is a transitory trend, which has been transitory for a very long time.
Temporary, not something that they want to take into account when it comes to inflation and what they do next. What about other policymakers? Have European policymakers, Mario Draghi, for instance, or the UK, Mark Carney, brought up oil prices and the move higher as reason to change their policy?
They have talked about concern about the drop in oil prices. I think that Europe, the people who I talk to say Europe is much more directly affected by the slowdown in China, more so than even the U.S. So, to the extent that the drop in oil prices of late has been related at all to what's going on in China and some of the slowdown there actually is an actual tangible reason that this slows the European economy that goes beyond just a technical bond yield correlation issue.
And quite frankly, Scarlett, the concern is that the oil price community will see even lower prices going forward. Barclays had a note out talking about the next glut we might see might be in the product market. That global refinery throughput is at a record high right now, almost 81 million barrels a day in July. Therefore, refiners work really hard, make a lot of product, margins are awesome, make too much product, margins not awesome, they're not going to work as hard, they use less crude, oil prices go even lower to demand that supply response.
So it all comes down to a very confusing and muddling read for policymakers. How are investors positioning themselves when they look at this rising correlation then?
Well, some people are it really depends on their worldview. It comes down to what's your biggest fear? Is it deflation? Is it inflation? Is it just you want to hold a lot of cash because you don't know what the direction is? And people have to kind of stick with that. The people who I talk to, rather than look to some kind of correlation, because even the correlation changes over time. There are times when it's been a negative correlation.
You can see it right on there on the chart. Just even a few months ago, that was a negative correlation.
Exactly. But it is telling that they're moving in such lockstep, because it does indicate that either oil or both the oil and the bond yields are indicating that people are reducing their expectations for growth.
Okay, correlation's not causation, though, right? We don't know what's causing what. What's the leading indicator here? Is it oil? Is it the yields?
The short market in oil. That's what I'm going to argue. Look at how many shorts are in the oil market, and then you'll know what's going to happen. Because when you have one headline, boom, you're going to have a really powerful rally when there's so many shorts in. That's what I would say.
I would say it's very hard to tell. There is some disparity right now. If I look at, for example, the five-year forwards, they're not showing the same kind of expectations for such a slowdown in growth that you would think from some of the bond yields. Bond yields have been distorted by some of the central bank buying programs. So there are a lot of technical issues that make it hard for me to really use either of them.
Sure,
I look at credit.
And it speaks to how confusing it is out there that everyone's looking at every kind of indication for correlation, for dislocation, to get some sense of what's going to happen next.
And there's been a breakdown.